I'm Leandra Letterman, and I'm really pleased to have a guest speaker with us today.
Hi, I'm Holderness, and I'm a tax professor at the University of Richmond School of Law, and it's time to break into tax.
Today's topic is SALT in a nutshell.
Well, Leandra, I think the SALT usually goes on the nutshell, not in the nutshell.
Wait a minute, doesn't the SALT actually go on the nut, not on the nutshell, or am I just nuts?
Either way, it's time to discuss state and local taxes. So we thought today we'd start by saying, what is SALT? Again, state and local taxes. First, and most importantly, it's not federal income taxation. States impose a wide variety of taxes, including income taxes, but also including sales and use taxes, property taxes, and various excise taxes. If you were to take a class in SALT or go into a general SALT practice once you leave law school, you'd probably spend most of your time on income taxes and sales and use taxes. So we'll spend our time on those taxes in this video. That's not to say that the other taxes aren't important, particularly property taxes, which are a major source of revenue for local governments. However, as relayed to me by other practitioners, the issues with the property tax tend to be a mile wide but a foot deep, making them less of a legal battlefield than we see in the other areas of taxation.
Something that may surprise students a little bit is that, unlike in federal income tax classes, there's actually a fair amount of constitutional law in state and local tax. Can you talk a little bit about that?
Yeah, that's exactly right. What makes SALT so interesting and different from Fed tax is that not only are you going to be working through the statutes of the various states and figuring out how to apply the statutory law, you're also dealing with multi-jurisdictional taxation. And that introduces a lot of constitutional issues that just frankly aren't there at the federal level, where you only have one taxing entity. So I think we can look at sales and use taxes and corporate income taxes at a high level to highlight some of those challenges that make SALT so interesting.
So sales taxes are probably pretty familiar to everyone in the US. You go into a store, like, for example, Hayes, in our Misconceptions About Tax video, you went into a bodega and you paid sales tax. You've got that on the receipt for the beer, I think it was, that you bought.
It was beer. I paid the sales tax on the beer. I did not pay sales tax on my haircut the next day. So we'll talk about why that's the case.
Yeah, so there's actually some interesting issues with sales tax, even though it seems pretty straightforward.
Exactly. So big picture, roughly speaking, the states with sales and use taxes, which are 45 of the states plus the District of Columbia, raise about a third of their revenue from the taxes. So these are a big deal for the states, but they don't all tax the same things. So statutory interpretation is really, really key in this area of law. So most states will subject sales of tangible personal property to sales tax, but not tax services. So what that means is, as we mentioned, when you're going to your bodega and you're buying chips or beer, you will pay sales tax, but when you get your hair cut or you pay someone to walk your dog, you typically would not be subject to sales tax on those types of transactions. The problem with taxing tangible personal property is that a lot of things that we need to survive are tangible personal property. So food, for instance. And so when measured by income, sales taxes are regressive. They require a larger percentage of the taxpayer's income to pay the same amount of tax, making the burden relatively more impactful on lower income taxpayers than higher income taxpayers. And since everyone needs a certain level of things to survive, a lot of states will exempt the sales of necessities from their sales tax basis. So what's a necessity? That turns out to be a pretty hard question to answer. Again, people need to eat, so food is certainly a necessity, but is all food a necessity? Is your birthday cake a necessity? Is your takeaway bagel a necessity? What about candy? These are real issues that are litigated every year, and we have administrative rulings and regulations on point, and we get some really fascinating results.
One example I've heard about where the tax treatment can vary depending on the preparation is with bagels. And that hits home with me because I'm a New Yorker. And when I go back to the city, I like to stop at H&H Bagels and
But
get a bagel.
I hope you don't get it toasted. One, because it's blasphemy to toast your bagel. But two, if you got it toasted, you probably got a sales tax charge that you weren't expecting.
I am happy to report that the H&H bagel that I remember does not seem to come toasted. And although I was not tax motivated in that decision.
So the reason for that being is that New York has determined that food that is meant for on-premise consumption is not entitled to the necessity exemption from sales tax. So when you toast that bagel, that's good enough for the New York Department of Taxation and Revenue to say, hey, you're eating that on the premises. It's not a necessity. It's not taking home for home consumption, and you need to pay a sales tax on it. The problem here is that unless you're going to put an auditor in every branch of H&H and other bagel shop in New York, how are you possibly going to know? So the New York Department of Taxation and Finance has decided to adopt an administrable approach. This really is probably one of the biggest tax moves in favor of pure administrability over efficiency or equity. There's principles you might have studied in your intro tax class.
And we have a video on that.
And so the reason is they just can't do it any other way. They have to get it close enough. This is a good enough proxy as anything else. And as another example of how ridiculous this can sometimes look from the outside when you're not tuned into those administrative issues is in my home state of Virginia and many other states, Twix is not considered a candy and therefore is treated as a necessity and exempted from sales tax because it has flour content. Skittles or something like that would not qualify for the exemption because they're pure candy. There's no flour in them. And that's just the line that we draw. So anytime you have line drawing like this, it really makes for an exciting area of practice, a really engaging area of practice, because it demands a ton of creativity and a lot of deft application of the statute, interpretation of the statute. So if you went into a SALT career, you would certainly be making these kinds of arguments. And that is just great. It's really, really fun and really, really creative and really, really frustrating sometimes for taxpayers. But that's the state of the world when the states have decided that some things should not be subject to a consumption tax, whereas others are.
So it makes me want to make some joke about a SALT bagel. And if you have a SALT bagel and you're interpreting the law, then you're really twisting yourself into a pretzel. Earlier, Hayes, you mentioned not just sales taxes, but you used the phrase sales and use taxes. And as I said earlier, sales taxes are probably pretty familiar to most people in the US, but use taxes can be somewhat less familiar, although they're quite important. So can you explain what a use tax is?
Definitely. So we've been talking about sales that are occurring within one state. You go to a bagel shop, you get a bagel, very clear where that's happening. Once you add in sales that cross state lines, things get a lot trickier. So the Supreme Court has ruled that the Constitution requires a state to have some minimum connection with a taxpayer or with someone who is being asked to collect the tax before the state can legally enforce that requirement. So if you're an out-of-state vendor, it's possible that you don't have that requisite connection or nexus in SALT terminology with the state. So if that's the case and you make a sale, then you're not collecting the sales tax, and the state would presumably lose out on that without some backstop. Use taxes are that backstop. So to make sure that their sales taxes, their consumption taxes didn't go unpaid in these kinds of situations, the states adopted use taxes that consumers are responsible for when sales taxes aren't collected for whatever reason. They follow the same rules, they apply to the same things. Basically, once you, the consumer, use a product that you have bought at retail in the state, you owe a use tax unless the sales tax has already been paid.
In addition to the relative unfamiliarity of the use tax, it's also a tax that experiences a high degree of noncompliance. And some of that may be ignorance, but some of that also is the difficulty of enforcing against a lot of individual consumers who are supposed to so-called voluntarily report that they bought items out of state that they used in state.
Can you imagine the compliance burden on an individual to keep track of all of their purchases that they didn't pay sales tax each year? It's an incredible burden on a taxpayer. And so it's really, I think, no surprise that those taxes went unpaid, though some states took some creative approaches.
My understanding is that where it tends to be enforced are things where you have some kind of title or
Mhm.
registration. So if somebody crosses the border to buy a car or other
Yep.
vehicle, that there's more enforcement with respect to that than if somebody crosses the border to buy something like an item of clothing that's lower taxed in a neighboring state,
Right.
for
And you're
example.
never interacting with the state government again. Yeah, exactly.
What some states do to try to help increase compliance with respect to smaller transactions is that they actually require reporting of use tax on the state individual income tax return.
Mhm.
Indiana is an example of that, so that there's a line for use tax.
My SALT professor told me the only people that used to pay their use taxes were federal judges and tax professors. So you and I are both in a bucket where we would be paying our use taxes. But in 2018, the Supreme Court modernized the nexus jurisprudence here, holding in the Wayfair case, which you may have heard of, that physical presence was not required to establish nexus, such that the out-of-state entity could be required to collect the sales taxes. Now, economic presence is enough. We don't quite know exactly how much economic presence is enough, but a lot of online vendors are now collecting your sales taxes when you purchase over the internet, which has really eased the burden on the states and taxpayers. If you went into practice, you would certainly be arguing these nexus issues as a SALT attorney. There's not many fields where you get to argue con law on the daily, and this is one of them. So that makes it for a really exciting field.
Let's now turn to income tax in the SALT context. And in a SALT class, you're not going to spend much time on individual income tax. Why is that?
You're not, because the simple matter is that most states will conform to the Internal Revenue Code for individual income taxation and business income taxation. And so we don't spend in class a ton of time looking at those state income tax codes because you're already doing that in federal income taxation. You're getting those skills and knowledge there. So it's very important to understand federal income taxation because that does make its way into the state tax codes. Now, huge caveat. There's not perfect uniformity at the state level to the IRC. So you still need to be comfortable reading tax statutes and paying attention to what the states do and do not conform to. So for instance, many states would decouple from federal provisions related to economic development or research and development types expenses such as accelerated depreciation, bonus depreciation. The federal government is already encouraging you to invest in your capital. The states don't really need to pile on necessarily, and so they'll often decouple from those types of provisions. So it's really important just to understand exactly how and what the states conform to, but as a general rule of thumb, the federal income tax code would apply in most situations at the state level.
Be sure to watch our federal income tax playlist and don't miss our video on how to read a tax statute. So where it really gets complicated is with respect to multi-state taxpayers. So this arises fairly often in the corporate income tax context.
The corporate income taxes are a really complex area of law. And in contrast to the property taxes, the issues here are a foot wide, but a mile deep. I think an important caveat before we discuss the issues with corporate income taxation is to note that in contrast to sales and use taxes, corporate income taxes actually make up a fairly small percentage of state revenue collections overall. Roughly 5% of revenue is from the corporate income tax. The individual income tax makes up about 40% of state revenue collection. So it is massively important to the states. But because businesses tend to cross state lines much more so than individuals, this is where a lot of the case law has developed in the area to establish sort of how states determine where income of a multi-jurisdictional taxpayer is. And though not all states do the same thing by any means whatsoever, there has been a movement in the last couple of decades towards answering that question of where the income is through what's known as formulary apportionment rather than a system of separate accounting. So formulary apportionment involves using proxies like the total amount of sales that the taxpayer has in the state versus the total amount of sales the taxpayer has anywhere, boiling those down into a percentage, and then applying that against the tax base. No one at any level is claiming this is going to be a perfect representation of the income that's within the state. It's meant to be an estimate. It is a constitutionally approved method of apportioning income, again, determining the in-state tax base, and it is way out of line with international norms.
So in the international context where you have different countries, there would be much more of an effort to assign a taxpayer's income to the various jurisdictions rather than simply making an estimate.
Exactly. And so the state's adoption of formulary apportionment has been met with some, I think fair to say, outrage from the international community. The states got a lot of pushback, particularly during the Reagan administration, from the European Union and Britain. And the states have backed off of applying formulary apportionment to international entities. And this has really been a domestic thing, although as the world is becoming smaller, calls for worldwide formulary apportionment are starting to be made again. So we might see this issue come up pretty soon. As I mentioned, the Supreme Court has blessed formulary apportionment as constitutional. And what they are looking for there is that the state is not attributing too much income of the multi-jurisdictional taxpayer to the state, such that it's really an unfair kind of burden on that multi-state taxpayer. And so what the court is looking for there is that the state is doing something that doesn't inherently result in double taxation by having factors or proxies that would be double counted in two states. So if you count all your sales and all your manufacturing or something like that, you'd run into an issue. Take your SALT class to figure out more. It's really hard to do this in a quick video, but the general idea is that we don't want to absolutely create double taxation. And we also don't want to create an undue risk of multiple taxation, though the Supreme Court has been much more lenient in that regard as a constitutional matter.
Is there any concern about under taxation, meaning some revenue streams just simply not being taxed by any US state at all?
Yeah, this is actually a major concern, particularly for the states. And because formulary apportionment is admittedly an estimate, there's a lot of ways to go about it and a lot of arguments you can make as both state and taxpayer to determine the correct amount. And so there is a concern that some taxpayers are able to game the formulary apportionment system, for lack of a better word, and cause them to be taxed on less than 100% of their tax base. Sometimes that's what the states want from an economic development perspective, but other times it's not. And so it gets really tricky to figure out what exactly is happening. And if you went into practice, you would certainly be dealing with apportionment issues, trying to make sure that the statute is being applied fairly to your client.
With formulary apportionment, how do you determine what the tax base is?
Yeah, so this is really, as described by the Supreme Court, the linchpin of apportionability. What is the actual tax base? Who are the taxpayers? And so when we're trying to figure out what the income tax base is that's going to be subject to apportionment, we look to all of the business income of a unitary business group. And this raises some constitutional concerns. So we have to define what the unitary business is. And the reason we have to do that is because we cannot let corporate formal structures change the taxability at the state level for the members of the group. So the whole idea behind formulary apportionment is that we are making an estimate, again, of the amount of income that the taxpayer has in the state. If we allowed corporate structures, the formal incorporation of parts of the business, to sever the ties to the income, then it becomes very easy to move income in and out of the state as the taxpayer prefers. So the unitary business group is a group of separate entities that are engaged in the same line of business. They're going to be commonly owned, they're going to be related entities. And answering the question of which entities are actually in the unitary business group is an incredibly difficult one. It is highly factually dependent. So you're going to spend a lot of time developing those facts, really understanding the relationships between the various parts of a related enterprise, with the ultimate goal of understanding who is all contributing to this line of business's income. We're really looking for the sort of hidden flows of value that exist within a business group, common expertise, right? The economies of scale that result from, operating various parts of a vertically integrated enterprise, for example, like an oil company, that's a major example, or a railroad. Each piece of track is really important to the entire enterprise, but it's hard to value that piece of track on its own. So there's a ton of creative arguing that's going to happen here because, again, we're looking at facts, we're arguing about the relationships, where those hidden flows of values are. A great example that I remember from my time in practice is, what if you have a local pharmacy, such as a CVS or a Walgreens, that also owns a prescription filling service like Express Scripts or something like that, an insurer? Are those the same line of business? They are related, but they might not be relying on the same kind of expertise, really getting flows of value between each other. And therefore, if they were separate, the state wouldn't be able to include all of the income of all of those entities into one common base, which it then subjects to apportionment. So we have to figure out that unitary business. Once we figure out which entities are in that, we put all of their income in one big pot, and we apply the apportionment formula against that, and the state subjects that to its corporate income tax. So the Supreme Court has issued a number of decisions about the unitary business concept, but some of the biggest ones are the Mobile case and the Container case. In Mobile, the court outlined that some of the main things that it thinks contribute to a unitary business that we should be looking for are centralization of management among the entities, functional integration, again, among the entities, and economies of scale that are produced from the relationships. They also noted that's not the only way to find a unitary business. And in Container, the court said, basically, we're going to defer to state court decisions about this as long as they are reasonable. So this is why there's a lot of litigation in this area and a lot of work to be done for clients, because the states can take different approaches. And so you have to be really flexible, really creative in the way you're thinking about the relationships that your clients have with other aspects of their related groups.
This has been S.A.L.T in a nutshell.
And I got to say, we really only started to crack the nutshell, if you will. There's so many more issues at the state and local level regarding taxation. We've done our best here to give you an overview of some of the major issues, but you will never be bored in this field if it's one that you enter into.
So definitely consider taking state and local tax.
Not only because the issues are so interesting, but also because there's jobs here. S.A.L.T is definitely a growing field and has been for some time. And there's a ton of places where you can find really interesting employment, big firms, small firms, accounting firms, governments, think tanks, a lot of options out there for S.A.L.T attorneys.
Thank you for joining us as we break into tax. Don't forget to like this video, share it with your friends, subscribe to the Break Into Tax YouTube channel, and turn on notifications so you don't miss a single new video when it drops.